This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. Do me a quick favor. If you like what you hear at Planet MicroCap, please take 2 seconds to give us 5 stars on Spotify or Apple. This helps with the search engines so that more folks can also discover and engage with all things microcap stocks. Next up on your microcap investing conference calendar, the Planet MicroCap Showcase Vancouver in association with Small Cap Discoveries, happening September 25 and 26, 2024 at the Fairmont Waterfront, Vancouver. We're about a month away now from the event. We got companies up there, speakers, sponsors, the whole shebang. We got all the information up on our website. Paul Andriola, Brent Todd, Jesse Gamble, Matthew Martine, Ryan Irvin, and Howard Leishman will be set to give keynotes in person. And we're still a month away. There might be more that we might be adding, but this is really one of the best lineups we've ever put together for any of our events, and one that I've ever seen put together for a MicroCap Investor Conference. So don't wait. You can register to attend at planetmicrocapshowcase.com. See you in Vancouver. Now, my guest on the show today is Sam McColgan. He's an analyst at Breakout Investors. While Sam is relatively new to his investing journey, he has dived right in, getting in his reps in and doing what some of the best investors in our community do, which is share their ideas to get as much feedback as possible. That's how you grow. That's how you become a better investor faster. In our conversation today, I wanted to highlight Sam's philosophy he's developed for himself thus far, his research process, and what his goals are. Thank you again for tuning into the Planet MicroCap Podcast, and please enjoy my conversation with Sam McColgan. Sam, thank you for joining me today. How you doing, man?
Very good. Thanks for having me on the show, Bobby. It's great to be here. I've watched the show for practically as long as I've been investing. So yeah, it's good to chat today.
So like 6 months, right? No, that's a terrible joke. Yeah.
Well, you laugh, but I am new on the scene, so you'll probably ask this in due course. But I've probably only been investing for about 18 months. I'm looking into investing for about 24. So yeah.
Well, that's why I wanted to bring you on today, man. You're relatively new on the scene. I see, new to Twitter, getting after it, putting your ideas out there. And, for our purposes, I mean, really where we kind of got our start was highlighting newer investors that are focused on small microcap. And you fit that bill, man. We've been doing it 9 years, believe it or not. So, we're sticking to our roots. So, like you said, you kind of got your start investing just even in general 24 months ago. I mean, we all know the obvious that we all want, future financial freedom and independence, and ultimately all for us to be private investors so we can live wherever the heck we want. But we still all have our different motivations. What got you started in the wide world of investing and specifically brought you to small microcap land?
Yeah, good question. So by background, I'm an engineer, studied civil engineering in college, did a master's degree, transportation engineering. And I started off my career kind of knocking down train stations. That was a lot of fun. At the same time, I felt that there was something missing from that kind of career. In particular, I think it wasn't as creative as I originally imagined. As an engineer, usually you imagine a super creative career. And I found that there's very strict guidelines in how you do things, and that's for very good reason, because if you make a mistake, it can cost a life, or lives. So as much as I enjoyed that career, there was something missing there. I enrolled at that time to go to Stanford, and I got accepted on a deferred basis. So my plan was to kind of go and do something in this space, but at the same time became a parent, and Stanford, when you're on deferral basis for Stanford, they encourage you to go and do something crazy. And I just thought, I've got an idea for a business that's to do with parenting. Why not just do something crazy in these 2 years? It's okay if I mess up. So I started down that path. Um, and it started to go well, but it was at that same time I caught COVID, and then I started to get like really quite bad long COVID symptoms, and I was now able to kind of, when you're starting a business, you need to do more than full time, and I could, that just wasn't sustainable. So
What a pain in the
I
butt
backed off
there.
that.
Sorry,
Yeah, I
man. No,
know.
it sucks. Feeling
Well,
better.
it
Feeling
sucks,
better now.
but
Feeling better now, though. Or
yeah,
still, yeah.
completely better. Yeah, yeah,
Oh, good. That's
that's
great.
totally better now, thankfully. Um, but yeah, at that time, let's see, where was I? Yeah,
Well,
at that time, I moved to Japan. The doctors in the UK weren't really able to figure out kind of what was causing it. We moved to Japan. Um, my wife also wanted to have our child in Japan, so that was another factor. And because I had a lot more time, I just started looking into different things, and I kind of was curious about investing, and I just liked it more and more the more I kind of studied about it, and then I started dipping my feet and found I loved it even more. And yeah, so since the last 18 months, just enjoyed it so much that I've decided actually this is what I want to do. I in a way, getting long COVID was, I'd say kind of a blessing. It redirected my path in a way that I otherwise wouldn't have gone. So it gave me an opportunity to learn something new, and yeah, and investing just fits me very, very well. It's got a lot of different things I like. It's creative, it's creative to kind of present a thesis and kind of go through the process of helping other people to understand why something's a good investment. It's also kind of relatively heavy on numbers. I've always been kind of a maths guy, but it's also about stories, and I love storytelling. Um, and then also I think it's a quite free career in which you can follow your interest, follow your passion, and be not always be your own boss, depending on kind of the exact career. But generally, you get a lot of autonomy in terms of the ideas that you're looking into and things like that. So, it fits me very well. Really enjoyed it. Oh, the other thing I love about it is I've always been the kind of guy who goes into a bargain, no, who goes into like a charity shop and just tries to find like this completely crazily cheap thing that, like this amazing toy for my kid that's like $5 when it should be $100 and things like that. So, I mean, investing is just for me like an extension of that, finding these like names that should not be priced how they are.
I was going to say,
So,
getting started in investing approximately 18, 24 months ago, and quickly realizing that there's a ton of these cheap potential bargains in small microcap, man, you were ready to go. I mean that because it's kind of been like that for a while. Yeah. Hey, real quick before we move to like how your philosophy, the way you're thinking about things currently. What was the business? What was the parenting business? From one
yeah,
parent
so
to another. I gotta know.
so the idea was, um, with social media, my wife, for instance, goes on Instagram and kind of gets like some baby ideas and things like that from Instagram. But my experience of kind of getting information from social media is, because the content originates from a creator and gets sent to everyone at the same time, maybe you only get like 25% of your audience, the content is relevant for them. So the idea was to kind of flip that around on its head, and that it's basically a social media side in that, um, creators would basically create tags or triggers on different posts. Say, this post is relevant for a child between 6 and 9 months old, and to do with walking or something like that. And then the parent, when they kind of go through different experiences, they only get posts that's relevant for the child at their age, at their kind of what they're kind of interested in. If they're interested in kind of, oh, I'm looking for food tips for my child, they'd get automatically all the relevant posts from all the people they follow for that particular child. So that was the idea of the
Hey man,
startup, and I think it's a good idea, but it would take so much work to get
dude,
it off the ground.
Sam, let me tell you something, man. Long COVID or not, That would have been very difficult to,
Yeah, for sure, for sure.
no,
No,
no, I like the idea. My algorithm on Instagram is literally like, yeah, geez, what is it now? It's running stuff and like kid stuff or like funny dad memes.
yeah.
So I, I'm right there with you in terms and cooking stuff.
Sure.
So I'm right there with you. You want it to be more time. So sorry, I wanted to go down that rabbit hole. I was curious. But all right, so you're been in about 18, 24 months. I've said that 4 times already. Sorry, everybody. But it's to set up the next question. All right. So but when did you start working at Breakout Investors as an analyst? It looks like you've been writing on there now for like what, about 7 months?
About a year.
About a year. Oh,
About
okay.
a year.
Oh,
Yeah, so I started in September. I I guess dabbled in a few different communities, and I really liked the breakout investor community. I thought the research I'd done was like extremely thorough. And also I felt that it was a more communal platform than some of the others I tried. So it's kind of a platform where everyone's welcome to contribute. And I found it was a place to, I guess, refine my theses, because I could write something and I'd get a host of other people say, "Oh, you're missing this aspect or that aspect." So it was a place for me to really learn quickly, and I think that definitely the best way to learn to invest is to write about your theses and share them online and have other people pick them apart. So you can you learn very, very quickly that way. And yeah, that's what I like doing. And essentially, I just kind of kept producing ideas and reports on different companies. And after a while, they said, "Hey, these are pretty decent at least. So why don't you join our team?" So yes, for the last year, I've been at Breakout Investors, and will continue to do that at Stanford.
yeah, very cool. So what was the first thing that you did? Say, okay, I want to go down this investing path and learn a little bit more. Because okay, most people would have said, maybe, that have been doing this now 15, 20 years is, they either just went in, got their start in, and then, read a few books on the way, started with reading a few books. Was it still the same process for you? Because I think a lot of people who maybe got their start, quote unquote, investing and or trading, they got started in 2020 in the middle of COVID because, they're seeing the market go nuts or crypto, whatever it is. So for you in 2022, what was that first thing?
I'm trying to remember what was the very first thing. Some of the first books I read were
Doesn't have to be the very first thing. It
Pete,
could be,
Pete.
a royal first
So
thing, the first few things.
the things that stick out to me the most were reading number one, kind of Peter Lynch, One Up on Wall Street, and what's the other one? The other most famous one. Don't remember. One Up on Wall Street was very good, and
Boy, for those
the
not
other
watching
book
the
I
YouTube,
read was
I pointed to Intelligent Investor. That was probably one of them. That one or
so I've
Common Stocks and
I, I've
Uncommon.
read The Intelligent Investor, but I found it. I wouldn't advise it for people who's very new in investing. It's a heavy read,
It's a heavy
but
read
Peter
for
Lynch
sure.
is a more fun, enjoyable read that can kind of get you dip your feet in.
100% agree
Yeah,
on
the other
that.
one that I liked a lot was Guy Spear.
Yeah, yeah.
Uh, valid, um, what is it? The education of a value
Education.
investor. Is,
Yep.
is that it?
Yep.
Yeah, that's it. Yeah, I really like that. And although he invests in quite different companies than I do, I really enjoyed his kind of philosophy and his approach to life around investing. So that got me kind of very interested as well. And yeah, I just thought I have this time, so why not learn how to kind of build up these assets? I mean, I didn't get involved when stocks went crazy because I was just too busy, always too busy with different things. But I had the time, and I thought, why not learn it? And the more I learned, the more I loved it. And more than anything, I was just curious and enjoyed looking at different companies and understanding how they worked. And one thing led to another, and another company led to another, and yeah, just
So how'd you
get
get
going.
how'd you get to playing in our neck of the woods here in microcap land?
I I think it's couple of things, but one of the main things that always sticks out to me is Warren Buffett's quote, where he's, or I don't know if it's a quote or something, but he says, if I'm going to do it again, it's going to be these small companies. That's the best way to do it. That's where you can generate the best returns. And for me, if you get someone like that, advocating for small stocks, then it just is almost a no-brainer. And I think you can generate good returns with bigger companies, but if you want to generate like crazy returns, this is just the best place. It's where the most mispricing happens. It is an area of higher risk, and in hindsight, the mega cap space would have been a much better place to play for the last year. But I didn't know that at the time, and I think even despite knowing now that, well, the relative returns of different markets, I'd say I learned a lot more looking at microcaps because there's not a lot of research out there, so you have to really do it yourself. So I think that's a big benefit to someone who's kind of learning to invest. Yeah.
And isn't it fun where you can actually get on a conference call and literally might be the only one either on the call or the only one to
Yeah,
ask a question?
happened to me today.
I saw your tweet. I saw your tweet. We recorded this on August 14th, 2024. I saw your tweet put out there. I was like, oh, that's so sick. I love that. That's the good stuff, right? Like that's the fun part about being in microcaps is that, there's so many times where that's often the case that you might be the only one on the conference call. You might literally be the only one to even ask a question because they have no analyst coverage whatsoever. And you're sitting there thinking like, what am I missing? Like, this is wow. Like here we go. Yeah.
Yeah. Happened today.
Yeah.
So yeah.
So Sam, got us to this point. I'm not going to say how long you've been doing this now because we've already said it 4 times, but now kind of give us what does that ideal investment kind of look like for you right now? Where are you hunting? What looks interesting to you as things stand right now when it comes to your philosophy and your criteria?
Yeah. So I'll walk you through my philosophy. I think that's the best place to start. So I have uh, 4 main categories that I look at. One's momentum, one's margin of safety, one is management, and the last one is a monopoly. So those are the kind of the 4 key things I'm looking for. So in terms of momentum, I'm looking for a company that has price momentum. And that's a relatively new thing for me. But I found that in microcaps, you can sit on a name that has a lot of value, but the market's not going to see that for a long time. And I want to generate returns so that I can get a good investing job after Stanford. So I don't necessarily have 5 years to make that much money. So I've got to show that I can get returns, more regularly, at least for now at this early stage in my career. So I'm looking for names where the market is already waking up to the value, and you can get that from the charts. And if the market's already waking up to the value, then you're going to get price realization much faster. Either way, if you have a company that's worth $10 and trading for $1, eventually it probably will reach its value, but you can do it much faster if the technicals are on your side. Aside from that, I'm also looking at momentum in fundamentals. So originally, I started off with a lot of names that had this great opportunity, but the rest of the business was struggling. And yeah, I guess learned from sad experience that that's not necessarily the best company to be invested in because those opportunities don't usually work out on the same timeline and may not even work out at all. So yeah, for now, I'm looking at companies that even if this kind of big opportunity, whatever it may be, doesn't work out, the core business is still improving. The revenues are heading in the right direction. The expenses are not increasing dramatically, that kind of thing. Increasing margins. Those are all the perhaps delevering. Those are the kind of things I'm looking for. Second one is monopoly. And I'd say it doesn't have to have a monopoly, but it should at least be the best player in the niche, like the number one, or arguably the number one. So there's a few companies who I'm invested in who have a monopoly in a niche, but we're talking about small companies, so they it's not like they're not over a huge market, but just what they do, they're like the only person who can do it,
Right. It's not
or
like
they're
a
the person
full
who does
on
it
anti.
the best.
Right. It's not like a full on anti-competitive environment. It's so niche that it's like, okay, there only is space
Yeah,
maybe for one or two. Got it. Yeah. Yeah.
yeah, yeah. Then I look for margin of safety, and that part I think combines both valuation and kind of an analysis of the risks. And more over the last year, I've learned that we as investors tend to underestimate the risks that are out there, and we tend to kind of overemphasize or be overly optimistic in terms of the good things that can happen. So, we often talk about risk reward, but I find that if we were to say, oh, there's 25%, it can go, this high, 50%, it'll go like in the middle, and then 25%, the investment will kind of really flop. When we track our whole portfolio, at least for me, I found that clearly my probabilities are wrong because I'm more than 25% is flopping, or something like that. So at least early on in my investing career, that was the case. Less so now, but now I'm really doing a deep dive on everything I can think of that can go wrong, and if there's something that can go wrong that breaks the thesis enough that I lose money, then I just stay away from the name. So that's a very harsh criteria, and many people I guess would not agree with that. But yeah, for me, I just think if I can imagine something that can go wrong, then I have to deal with that risk. And there's also the risk that something I can't imagine will go wrong. So I've got so many risks that I have to kind of watch out for. Whereas if I can't think of anything that will go wrong, then maybe something does, but at least, I've covered everything I possibly could. So
By
that will reduce some of my upside potential, but it has significantly limited my downside as well.
Oh, that is probably by far the hardest thing to do. Just whether in business or in investing is trying to imagine all the different possibilities. Because then, black swan event happens and you're like, oh, how could I possibly predicted that? And
Yeah, yeah,
so yeah, definitely, it gets easier over time. Just from experience and having interviewed so many of these companies for the last 13 years. I've now developed a like, all right, my first thought is, all right, how does this go wrong? So I've had to
yeah,
train my brain immediately because in microcap, what can possibly go wrong, the likelihood it will go wrong is high. Whatever that percentage
yeah,
might be, maybe greater than 50%, maybe it's closer to 50%, but
sure.
still maybe greater than 50%. But that's just in general, it can go wrong. And then it's about drilling down into like, well, what is it that might actually go wrong? And maybe I'm wrong about it being wrong. Anyways, I digress. I want to hear more about
Yeah, for sure.
now management. You were saying the fourth M, which by the way, I hope
Yeah,
you realize
management, the
this is
last.
you intentionally made this all an alliteration, right?
Well, I did. Well, I found that like three or four were, and then I just played with the last one to make it work.
Ah, the
But then
kid. There you
afterwards,
go.
I
That's the
realized,
writer
oh
in
no,
you.
it's actually been coined by someone already. I found out after I made my 4Ms that
Oh,
Phil
dang
Fisher
it.
also made 4Ms, and no, not Phil Fisher. I said the wrong person. Who made 4Ms? I don't remember. Some other famous investor, but
I don't even
yeah,
know.
they had slightly different M's than I did, so I guess it's okay.
Don't
Um,
worry, for the title, it will just be the names of the M's, not the actual four M's. But anyways, continue. Management.
maybe we can call it McColgan's M's. There's a
McColgan's
nice
M's.
alliteration there.
Oh, there you go. I like that. Oh man, that's funny.
So the last one's management, and I think this one's fairly straightforward. But I want to invest in teams that have not top notch management, and particularly have management that follows through with what they say, has high integrity, and yeah, who I trust to share things in a timely way and to allocate capital in a shareholder friendly way and things like that. So yeah, and those are typically, I'd say, founders, or at least have a lot of stake in the company, preferably bought in.
Very cool. All right, so let's talk about the research process. When you're out there doing your due diligence, obviously, one of the best parts about putting your thoughts out there and being on Twitter is being able to network with folks and, finding new ideas that way. But let's say outside of network, how do you typically come across a new idea? What are some of the things that you look for first, and then that inspire you to do the deep dive?
Yeah. So, although you set up the question in that way, I have to say every single name that I've got recently has come through networking. I just get so many good
I,
names through networking that I have
yeah.
no time to run screens, no time to like read through every press release like ever from every company. But, there's what I found is investors love to kind of share their best ideas. And the wider you spread your net, if you get everyone's best idea, then you just sift through those and you're going to have a very strong portfolio. So, yeah, I don't find investments in any other way at the moment, so I'm afraid I can't give you any clues there. But
Okay.
in terms of
Next step.
how I sift those down,
Okay, there you
yeah,
go.
um, yeah, I guess it comes down quickly to the criteria. I mean, I'm easily able to say this is a crowded space. Are they if they are, that's fine. But are they the best in class? No, they're out, and I just skip over them quickly. It could be that it looks very expensive, and I can't find a justification for it. I'll give you the kind of investment. I'll give you one investment that I'm looking for that I think paints the picture very well, and then a lot of my investments fit it to the similar mold, but they're in different industries and spaces. So one that I like very much, and I will disclose that I have a position in this name, um, Creative Realities, and that's
Yep.
CREX ticker. What I liked about this name, and this actually, by the way, is one that I did find myself. I found it before I started expanding my network.
Wait,
But
you didn't hear the interview with me? No, I'm just kidding.
actually, no, I
I'm
think
shit.
no, the interview with you was when I was introduced to the name. That
Oh,
was when I found it.
sick.
Yeah.
Okay, there you
So
go.
I happened to watch a show, and I was very curious of the story. So that was that.
All right, right on.
So here's what I liked about the company. Um, they hit something like 45 million revenue last year, and they guided towards 60 to 80 million the next year, and that's a huge range. Like it's a crazy range. And there's reasons for that which I won't go into, but basically, when you do the maths, you can say, okay, they're probably going to hit within this wide range. It's a wide range. You talk to the CEO, and he just thinks there's just no way he's going to miss that 60 million, and he's just wondering how high up to the upper end he might be able to get. So, in that kind of situation, and a lot of the contracts are already locked in, there's not really a realistic way they're going to miss 60 million. And if they do, it'll be marginal. If they hit 59, who cares? It's close enough. When you do the maths, if they hit 59 million, the company's really cheap. So, that's the downside, that maybe the company goes up 50% because it's just cheap compared to what it does. If it hits anywhere else in the spectrum, if it hits 65, if it hits 70, it's starting to look really cheap. So, in that case, this is the general model I apply for everything. I look for something where's the something that can go wrong? Is it still cheap even if it goes wrong? If the answer is yes, then I become interested and I start looking into it more. And then I start to consider, okay, if things go right, well, what's the upside? So I always start with kind of the downside model. What's going to go wrong? And, if that thing does go wrong, am I still at least making a little money? Probably. Uh, then that's really the approach I take. So, and,
You
and
know,
in terms of how I figure that out, I guess I might start with just asking whoever knows the name well to just talk me through it, and I try to poke holes in their idea, and I see how robust it is. So that's probably where I start.
got you said something that actually relates to what you're talking about in terms of because realistically, it sounds like you're looking for ideas where it realizes its value within let's call it 1 to 3 years. Yeah,
Yeah,
is that
that's
fair?
fair. Yeah,
Okay.
yeah.
So how important then is guidance for you so that you actually have a benchmark of saying, okay, company, I'm really want to be on this for only 1 to 3 years. The company is saying that they're guiding for this. That gives me a benchmark so that I know what to look for. So how important is guidance for you in that case?
It's certainly not critical, but it's a helpful thing to have. In the case of creative realities, it helps to frame my thinking. But I'm invested in quite a few companies, and particularly in microcaps. I don't know what the percentage is, but let's say only half give guidance.
Yeah, not a lot
Um,
give it. That's why I was curious. Like it makes your job way easier, where you're like, okay, they're
yeah, for
guiding
sure.
this. All right. Especially when
Yeah,
because a lot of folks that I interview on here, right? They don't have, some have that 1 to 3, they might have certain theses that might be, all right, this is a 1 to 3 year
yeah,
play, and then others that are 3 to 5 year. Usually the 3 to 5 year like guidance, they throw it out the window because it's like, all right, 3 to 5
yeah,
years, like they miss a little guidance here, big deal. If they're talking 5 years, they want to be
yeah,
here. That's really what's most important in me understanding the thesis and building the thesis for the company. But when you're talking 1 to 3
yeah.
years, you know, it's just helpful. It's very helpful,
It
right?
it definitely is. Though, you know,
But not a
there are
prerequisite
other companies. Yeah, definitely not, because you can, even if they don't make the job very easy for you, you can usually figure out roughly what it might look like, because you can look at how is the company been growing. Let's say the growth slows down. That's your worst case. So you just have to make a kind of an educated guess. How much is locked in, and how much is one-off revenue, how much is recurring revenue, and you can take an educated guess in terms of, okay, worst case, maybe they're growing 15% a year, maybe they only grow 10% a year. How do the numbers, filter through if they only grow revenue, X amount? So you can figure it out. I think most of the time you just have to do the extra legwork. Talk to the management as well. They often, although they don't guide, they often give clues. So you can figure it out.
for sure. No, I mean, were these similar theses that you had for, you just came out with a post, literally, what was that, 2 days ago, about 3 names that you added to your portfolio. The first two
Yeah.
are, I argue, I don't want to say microcap cult names, but have been well known amongst
Yeah.
our ilk for a while now. The two names are GeoDrill and Kraken. For full disclosure, not a shareholder, but they have presented at many
Yeah.
of our events over the last few years here. So was it a similar? What about these two companies kind of fit that 1 to 3 year time frame that you're looking at? What jumped out at you?
Yeah. 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 So I'll quickly just say shareholder in all three. Yeah. So let's take GeoDrill. They're essentially turning around their company. They're basically moving their drills from a high risk area to a low risk area. And that kind of is music to my ears to begin with. And then, because of that transition, their financials suffered. But all they need to do is just start renting out their rigs again. And there's no realistic, feasible way they're gonna not return to somewhat similar levels of utilization that they already had. And assuming they do, the numbers just make the company look very cheap. There's not, think like a really explosive upside, but the downside is just so well covered. They're trading for, I don't remember, 70% of their assets. And when you're when you buy in a company that cheap that does rigs, that doesn't apply for non heavy asset companies, but for something that leases out rigs, it just makes it very easy. Um, Likewise with let's say Kraken, their core business is growing well. So this is a company that is not as cheap as I usually like to buy, but based on the trajectory and based on this is a defense company for people who don't know it. Based on kind of how the world is going, defense ramping up everywhere. There's realistically, it's very hard to imagine a scenario in which they don't continue growing. If not, I would expect them to kind of increase the growth. But let's just say, even if they just hit similar rates or even, slow down a little, in a year or so, the valuation makes sense. And then you have kind of an explosive upside with that one, which is if one of the people they supply, Anduril, if they've essentially made a plant of which Kraken will be a supplier for all the UUVs, the unmanned submarines, basically that they produce. So, assuming they start producing submarines, which is likely at some point, likely within the next year, then the upside becomes very, very big. So, both of these fit in very well to what's the downside, and is there some sort of upside? And likewise, Locify's. I don't know if you ever uh, come across a company before. It's probably the most explosive upside of all my names. But the downside risk is relatively well covered because the stock has been really crushed. Like it's been really crushed, and there's relatively good reason for that. If you look through the history, they've kind of struggled to get to that point of which they're breaking even, but they're very, very close now to breaking even. Probably this quarter, if not the quarter after, they'll be breaking even. They said, look, last quarter financials have bottomed out and they're already improving. They basically run into some issue with uh, basically Google changed their algorithms in a way which affected the people they are serving. So although it's not really their fault, and they actually have a solution that can help fix those algorithms faster than anyone, not fix the algorithms, fix the response to the algorithm change faster than anyone else can. It still affected their revenues in the short term. But anyway, we have a case where they've essentially bottomed out financials. We know that the fundamentals are improving. They have that momentum. And then they have some enormous deals like on the horizon that if they get them, this could easily completely explode faster than any of the other names. So, that's just a nice one to have in my pocket. I like names where the momentum's changed and the market hasn't quite caught up to that yet.
For sure. Actually, I did an interview with Locify. I looked at your article 3 times. I was like, I know this company. I feel like I know this company. And then I looked. I've done a lot. Look, when I first got started, I remembered every single company I interviewed. Now I'm getting a little gray hair.
There's so many.
I got baby brain at this point. Like once you have kids, you know how this happens.
I know that feeling.
but actually, I interviewed Locify February 2023. So the stock has cut in a third since then. But and actually, it's interesting.
It's probably a good one to revisit in the near future because their story has changed, I think.
No, for sure. That's actually a perfect example of a potential black swan event that unless you're really in the industry, you would never know. Like one of my close friends is in SEO, and I remember he experienced something similar with a site that was generating a ton of cash, and then all of a sudden Google changed it up from an SEO perspective, and that was it. It was basically like these not ghost websites, but basically like the websites that are just generating content and then being resellers of whatever products that they're backlinking on there. That can be very lucrative for quality product, that kind of thing. But when Google changed it up, they really just focused on, anyways. That's actually a perfect example. So that's interesting that, I'll have to take a look at that. Maybe we'll do an update and see how they solve that issue. Cause that's some of my favorite stuff is understanding how companies like overcame, something a major headwind, what they did, how they overcame it, and how what their solution was, right? I'll definitely take a look at that one. What would you say? And again, that's you own all three of those names that we just talked about. So so far in your career, what would you say has been an experience that's either affected your thesis, your philosophy? What would you say is an investing experience that affected anything having to do with where you want to go as an investor thus far?
We've spoken about it before in different ways, but the biggest way that I've learned is losing money. There's nothing like a sucker punch that will teach you to kind of tighten up your theses and
every time.
So, I mean, really, the whole last 24 months for me has been a journey of learning how to read risks and to avoid risks. And I've lost money on a lot of names. And, I'm not sure people should necessarily follow me until I got a much more of a track record. But I would say that overall, I've lost money to date because, my initial loss of not understanding what I was doing has not yet been covered by my understanding now of actually how to do it. But things have switched around quite significantly, and I am quite close to that point now, which will be kind of a happy moment for me. But yeah, I mean, I'd say that losing that money initially, it's it's an expensive tuition, but it's also one that I don't think can be learned any other way. When you invest in the good times, I think you're not incentivized to refine your ways of thinking. But losing money has like taught me like so much. So yeah, I'd say that's the biggest, the number one thing.
I think
I'd recommend all investors lose money,
I think
at least at
actually
some point.
I think it was in one of my conversations with Ian on the podcast over the years where, because we talked, there's been many like, I mean, microcaps are volatile no matter how, the larger markets are doing. But I always remember him saying, I judge a real, not that he judges invest, but like, it's curious once you see investors go through an actual bear cycle, what happens,
Yeah,
and how they handle that. It's because, like you just said, it's easy to be a great investor when, you throw a dart, and everything is hunky dory. But it's another thing when, it's rough out there. And my word, did you get into small microcaps in like one of the roughest times for microcaps?
yeah,
For
it's the
sure.
worst time.
By
It's been
far.
awful.
It's been pretty rough. But at the same time, it's also that's what's been really fun for a lot of high quality investors too. Because now,
Yeah,
I mean, a lot of them are like kids in the candy store. I mean, I don't know, even especially on the Canadian side. I mean, these, all these companies are getting scooped up left and right, and if you're just coming into it,
yeah, yeah, yeah.
you don't have the reminder of like, oh, this stock was actually trading at,
Sure.
the stock is down 80% and now it's getting for premium at, down now from 50% from its highs. For you, it's like, no, I just picked it up at its lows and I made a nice premium. But that's a nice thing that you can now experience. But yeah, I think we're pretty much there, dude. I mean, I'm definitely going to be following along your career here. I know you're making the move stateside to go to Stanford, so I hope to, connect with you in person once you get out here to California. And for those that want to follow you, get some more information on Breakout Investors, to read your thoughts and insights, as well as following on social media, where should folks go?
Yeah, so if you want to follow me specifically, I'm on X, formerly Twitter. I'm on Substack, and I go by the handle at Sam McColgan, so just my full name. And you can also join our community. It's free to join. It does have like a paid membership tier for some of the more detailed research, but I joined the community as a free member and just I'm a really cheap guy. I hate to pay for things, so I stayed on the free tier and found it so valuable that I ended up kind of joining the community in a more proper way. Um, but yeah, so you can join the Breakout Investor community. I'd really recommend it. It's not just me. There's a lot of other like really great investors with a lot more experience than I have. I feel like the junior guy who's just at university, learning from all these experts. Yeah, so those are probably the best places to find me.
Absolutely. Well, Sam, thank you again for joining. I'm sure we'll do an update again at some point. Good luck on the move. Stay safe, and I look forward to chatting with you again.
Yeah, Bobby, it's been a pleasure. Thanks for taking the chance to chat.
Thank you.